My name is Morten Skipper. 4 years ago, my family and I took the decision to move from Denmark to Luxembourg.
My name is Vittoria. I lived in Italy before moving to Luxembourg 6 years ago.
I'm Cara Brown. I moved from New York to Luxembourg 2 years ago.
The thing that stands out to me in Luxembourg compared to other places is the ability for me to combine my career with a really good family life. So for us, it was very important that the kids would be exposed to other cultures and also have the English language as a first language. That is why we chose the international school system. But there is of course also the European school and the public Luxembourgish school system that offers a curriculum in English too.
After checking my emails in the morning, I take public transport to go to the office, which is very convenient and it's for free. I think that Luxembourg offers a high degree of diverse opportunities, particularly in the financial sector, because it's one of the main centers worldwide.
I love that it's so unbelievably international. You always meet people from other cultures, other nationalities. It's of benefit also in the work environment to have people from different nationalities.
I am the head of investor services and I manage teams in Mumbai and New York. Here in Luxembourg, people seem to make time to talk to each other. It's not the uptight, all business all the time type of attitude. There's a lot of knowledge sharing here that goes on, so that's been a huge help for my career.
The last 2 years, I've been working in private equity. I think that the environment for private equity is really exceptional. It is growing into a major PE hub, and it is growing in an incredible pace.
I have a dog and a horse, so I love to spend time with both of them. Mostly in my free time, I try to go for walks in the woods. It's my personal peace palace, I call it.
If I'm not working, whenever possible, Declan will ask to go over to the pirate ship park where he can run around. They've got the sand, the water play in the summer usually, so you'll see all the kids splashing around playing with all the various water, and the parents can chit chat and keep an eye on all the kids running around, so it's a really good spot. You kind of learn to just chill a bit, and you just take it in and enjoy your family life, your new friends, colleagues. It's been a really great experience so far.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Ladies and gentlemen, good morning and welcome to this new episode of our Focus On series. Today we have decided that we would like to focus on life after Brexit. As the transition period has come to an end at the turn of the year, Brexit has become a reality. The agreement that has been concluded on December 24th contains hardly, if anything, on financial services. While some may deplore this, the financial industry itself seems to have moved on and is settling into a new reality. Indeed, it seems to have put the more than 4 years it had in order to prepare for this to very good use, and hardly any hiccups have so far been reported. But still, questions remain. What are we to expect of this new relationship? Where is the UK going from here? How will the regulatory framework continue to evolve? And how is the financial industry actually managing in this new context? These are the questions that we will discuss today with our cast of superb and outstanding speakers, whom I would like to thank, of course, for taking the time and sharing their expertise with our audience, you. I would also like to express my gratitude to the sponsors who support this episode in our Focus On series. Now, our first speaker hardly needs any introduction because he's none other than Luxembourg's Minister of Finance, Pierre Gramegna. He will share with us his view on this new relationship.
Ladies and gentlemen, and dear participants to the seminar organized by Luxembourg for Finance on Brexit and its consequences and how we will live in the aftermath of it. Now, it took a couple of years to get where we are since the referendum in 2016, and here we are now with two new pieces of information that we were all expecting at a certain time. Number one, just before Christmas, a cooperation and trade agreement was signed between the European Union and the United Kingdom to organize the relationship between both our countries or regions from this year on. It's good that there is an agreement, even though it is not complete, but at least we have a basis to start from. The second good news that came in the last couple of weeks is that we now have a couple of vaccines that are now present on the market, that are being used, that have a high reliance and good effects and are very efficient, and that we see the light at the end of the tunnel in the pandemic. So, based on these two good events recently, to which I would also add the fact that the new President of the United States, Joe Biden, is committed to multilateralism, well, we have a framework that is good for the future. Now, if we look at the relationship between the United Kingdom and Luxembourg, and more specifically the City of London and Luxembourg as two financial centers, I would say that we've had a remarkable cooperation over the years, which is best shown and epitomized by the cooperation in the field of investment funds, where the asset managers are based in London and the administrative services are done in Luxembourg. This complementarity has worked well in the past, and we look for a future cooperation where this will be as good as it was in the past. Now, this being said, it is clear that the fact that the United Kingdom is losing automatic access to the EU single market in terms of financial services has obviously brought about a few changes in the last couple of years. We've seen more than 70 companies that were not present on the European continent set up a base there, be it in the field of asset management, be it in the field of fintech, be it in the field of wealth management, that have decided to be present on the continent with a subsidiary in Luxembourg. Well, we're very pleased about that development, but obviously it shows that there are some adjustments that are happening. This being said, it is also clear that we need to find a new way to cooperate with the United Kingdom in the future. Unfortunately, the trade and cooperation agreement between the United Kingdom and the European Union has not focused on financial services, so there's a road ahead of us how to structure that cooperation in the future. Now, the catchword here is equivalence. Coming from a presence of 47 years inside the European Union, it's clear that the United Kingdom has basically the same regulations as the European Union by definition. So that should make the discussion about contemplating the fact that our regulations are similar or equivalent should be easy. But obviously in the future that cooperation needs to be worked out, and we as Luxembourg have been advocating inside the EU that this dialogue should be structured and regular to give all the actors the necessary predictability, because that's what investors want. Now, I cannot anticipate how that dialogue will evolve in the coming weeks, but for us, Luxembourg, it is clear that we should make sure that we transform what used to be an automatic access, a kind of 4-lane freeway, in at least a 1-lane road. A 1-lane road is exactly what we need so that cooperation is easy. What we should also look into and avoid is that to use the exit of the United Kingdom as a pretext to build a fortress Europe. In fact, in the field of investment funds, and I would say in financial services in general, very often Europe has set the standards that are being used by others. Investment funds is an example. I would say that the taxonomy, green investments, climate-related investments could set the standard for the future. So let's not try to close the EU single market for financial services. Let's try to make it prosper so that it can be attractive for outside investments from all over the world. And that we could do with the players based in the City of London. So that's how I see the future. A lot of work ahead, a lot of decisions that have to be taken. We need to have a better view of the framework, how it will play out. I'm very confident that Luxembourg will be an important partner in the context of Brexit to make it smoother than it would be otherwise. And one last thing, it is interesting to see that because of the exit of the United Kingdom, the legislation of the common law that is existent in London is being often replaced by a continental European legislation, and very often the Luxembourg one. We see that at the stock exchange. We've also seen it with the European Stability Mechanism that has decided to use Luxembourg legislation for future activities and issuing bonds. So what it tells us is that our legislation, our legal framework in Luxembourg seems to be quite attractive. It's more typical continental law, but still very friendly for business, and that's how we are. So welcome to this seminar, and I hope you will enjoy the discussion. Thank you for joining us.
Thank you, Minister, for these candid words. And now to discuss where Britain is going from here in financial services, we will switch to London. And now to discuss where Britain will go from here in financial services, I'm very happy to be able to switch to London and to be joined by my colleague Miles Celic, CEO of TheCityUK, the industry-led body representing financial and professional related services in the UK. Miles, thank you very much for joining us. I hope you're doing well. Have you received your vaccine already?
I'm a little way down the list, but delighted to see the progress that we're having here in the UK with the vaccine rollout.
Very much so. I think that some people in Brussels can take a cue of that, because when they discuss competition potentially coming from London, this definitely also should be something that they should look at. Miles, the British government, after seeming to neglect financial services, at least seen from the outside, in the negotiation process as well as in the agreement that was concluded, has launched a consultation process to get input from the industry on new initiatives. What can you tell us about this process? And more generally, what can you tell us about your expectations for this new relationship?
Well, Nicolas, thank you very much for inviting me to speak to you and to your guests here this morning. I'd like to, first of all, thank you and the team for all the work that you've been doing. And I have to say, it's a particular honour to be following the finance minister. As you know, the UK and Luxembourg have always had a strong relationship, and even more so in financial services. And as numerous TheCityUK delegations have seen over the last few years, I think it's always notable just how like-minded the UK and Luxembourg are. Both countries support open markets, both recognise that capital markets are global and connectivity, not fragmentation, is key. And I think that's something that will be even more important as countries and companies rebuild from the economic shock, not just of Brexit, but of COVID-19. And I think we can see this clearly, for example, in the interconnected nature of the UK and Luxembourg asset management sectors. And there's a shared understanding that financial centres complement rather than just compete with each other. But I don't think there's any denying that Brexit has changed the nature of the relationship between the UK and the EU, and indeed the UK and Luxembourg. We no longer sit around the same table at the EU, and in many ways the day-to-day way of doing business has changed and will continue to change. I don't think it will come as any surprise that the UK's relationship with the EU is something that is of enormous importance for our industry, not just in Britain, but across Europe. It's a relationship that, as we've argued for some time, mustn't lose sight of the interests of citizens, of customers, of stakeholders, and of employees. And that's why the TheCityUK welcomed the agreement between the UK and the EU on the Trade and Cooperation Agreement, TCA. But I think we were all very clear-eyed about what it delivered. The TCA had little coverage of services in general and financial services in particular. And it didn't go into as much depth in those areas as might have been hoped for, as both Boris Johnson and the Chancellor Rishi Sunak here in the UK have said. So the priority must now be for both sides to use this agreement as a foundation on which to build, rather than being a ceiling of ambition. And I think there was real concern about an acrimonious exit with no deal. And the fact that this has been avoided gives us a platform now for strengthening the relationship between the UK and the EU. And that goes beyond just financial services. As you said, our ecosystem also covers related professional services. So mutual recognition of professional qualifications, the UK's accession to the Lugano Convention, and clarity on business mobility provisions are all areas where we hope we can see some progress. And while the deal had less for our industry than we might have originally hoped for, I'm sure we'll all be reassured that there's been no unexpected developments at the end of the transition period. As we all know, our industry is very highly regulated and has a broad range of vital services that it supplies to the rest of the economy. And since the referendum, the industry has worked closely with regulators and with governments, both in the UK and the EU, to ensure that all preparations were made in order to minimise the risks of disruption. So we've hoped for the best, but we've prepared for the worst. So firms are in good shape. For the EU firms servicing the UK, I'd argue it's been a little easier, as the UK has created a temporary permissions regime, which has worked well. As expected, some share and equity trading moved after the 4th of January. But on financial stability issues, which was the primary concern of regulators, the fact that the EU has already moved the grant equivalence to clearing has helped solve a lot of the cliff edge concerns that existed. A key point about this deal from a financial services perspective is that both parties, both sides, will by March this year agree a memorandum of understanding, an MOU, establishing the framework for regulatory cooperation and dialogue. And I think we need to be clear that this isn't an additional trade agreement for financial services, or is not about granting market access. It's about giving a structure to how we cooperate and communicate on these issues. And this is something that industry on both sides of the channel has long been calling for, as you know. and we hope the framework can be agreed soon. We would have preferred to see that text on regulatory and supervisory cooperation included in the FTA, not least to ensure that it had a more solid legal basis. However, we do welcome the commitment by both the UK and the EU to agree this MOU in order to establish the framework. So the MOU will not cover market access. This will still be governed by the equivalence provisions, although the MOU might help in establishing informal consultations concerning decisions to adopt, suspend or withdraw equivalence. But we should be clear that this process will remain autonomous. What we do hope is that the MOU seeks a consistent approach to changes in regulation or the development of new regulation with a view to avoiding opportunities for regulatory arbitrage or cooperating in relation to international standards, both in terms of their development and of their consistent implementation. And we also hope that both sides consider the impact of new initiatives on market operators in each other's markets and structured engagement with industry representatives. What we understand is that it will be based on the US model, and we hope that there can be improved transparency with industry when the regulators cooperate in order to ensure that there is a proper flow of information. But we have to be realistic around this. The success of the MOU will not just depend on the architecture that's put in place, it will depend on goodwill and trust on both sides. So we're reassured by the strong links between regulators and the high regard that EU supervisors have with their UK counterparts and vice versa. And we hope that this will help to continue to build the future relationship between the UK and the EU in this area. And the strength of that regulatory relationship should be at the heart of the approach on equivalence. So equivalence decisions, in our view, should be technical decisions based on the regulatory framework of the third country market. An ongoing politicization of this process would be a retrograde step in our view. And the regulatory process should be entirely technical and independent and based on practical outcomes. And we welcome reports that there will soon be a positive announcement on data adequacy. The technical way that that decision has been handled does raise questions as to why equivalence couldn't have been handled in quite the same way. Both processes allow for withdrawal should either side diverge, which also raises further questions as to why there's been this insistence on the EU side on making forward-looking equivalence assessments with regard to the UK. The rules the UK has onshored are identical, and the UK has historically taken a leading role in shaping EU regulation. So rightly, in our view, the UK has granted the EU a wide-ranging set of access rights, having decided to take an open approach to market access and to competition. So it's disappointing the EU hasn't taken the same approach, but we do welcome the temporary CCP equivalence. But given that the US CCPs, which operate under a very different regulatory framework, have recently been deemed to be equivalent, we would hope that the UK CCP's equivalence will be extended past June 2022. And we also hope and continue to hope that the EU will grant further access in time, as it has done for the US, for Japan, and for other global markets. And we'd argue that further equivalences would benefit all sides, especially when it comes to customers and clients in the EU who want to buy the best and the most effective services, the most cost-effective services in particular. So whatever the EU does, our industry wants the UK to remain open, it wants it to remain outward-looking, and to continue to be one of the most globally competitive places to do business. But being competitive doesn't mean a reduction in standards or in quality, and there's no desire for this amongst our members. Of course, approaches will inevitably change and evolve over the years. However, there's sometimes a misleading impression that any divergence will be solely on the UK side. The UK will inevitably refine its regulations and its legislation to adapt to being a single market of one country of 68 million people, with hopefully terrific international engagement with many other markets, as opposed to being a market of 28 countries creating regulation, or part of a market of 28 countries creating regulation for that shared single market. But it's also worth being aware and keeping in mind that the EU is going through its own process of changing its regulation and the philosophy underpinning that regulation, with seemingly more of a focus on market location rather than on market efficiency. And the EU push to onshore capital markets activity risks adding unnecessary cost and friction for European clients and savers. And in some areas, we're already seeing moves by the EU away from the status quo on Basel implementation, for instance. The differing approaches of the UK and the EU will see the UK taking a more technically led approach than the EU does in the view of some. MiFID II is another area where changes in approach have resulted in the UK having more stringent requirements. On the UK side, as I say, no doubt we'll see refinements and fine-tuning of regulation to reflect the specific nature of elements within the UK market. But those changes in approach should not be taken as a reason for either side not to grant equivalence. Equivalence shouldn't be a line-by-line assessment. It should be a practical, outcomes-focused exercise. And there's no doubt that the UK and the EU will continue to maintain high standards that respect their autonomy, whilst also protecting financial stability and consumer protection. And in emerging areas, such as sustainability and digital finance, where there's a less established regulatory framework, of course there is more likelihood of divergence and evolution in our own directions, which is why discussions between UK and EU regulators are important to understanding how those jurisdictions are approaching those issues. And there'll also be differences in approach to legislation. As the UK adapts its regulatory framework and its legislative processes, it will look very different to the structures that exist within the EU. There's already been a significant amount of power transferred back to the UK regulators from EU bodies, and this additional power needs to be balanced by appropriate accountability and scrutiny mechanisms here in the UK. And there is a desire from the British industry to maintain high regulatory standards while keeping rules proportionate and relevant to the UK's unique position in global markets. There's no appetite from our industry for a regulatory race to the bottom. The UK's high regulatory standards are a strength, not a weakness. And the world-class reputation of our regulators is an asset. However, a cultural change is needed, we would argue, to ensure that regulation is proportionate, tailored, and responsive to market changes. The UK doesn't have the capacity to rebuild, for instance, the Lamb for Lucy process. But what we do want to see is an enhancement of the role of the Treasury Select Committee here in the UK House of Commons, and the creation of a new joint select committee on financial regulation between the House of Commons and the House of Lords, the upper chamber here in the UK, to consider the detail of financial services regulation. And we fed into government consultations, and we hope to see the government prioritise re-regulation, not deregulation, and to consider the proportionality of regulation. And as you've already touched on, there are a number of reviews underway here in the UK looking at the future of the UK financial and professional services ecosystem. So we have the Khalifa review on fintech, the Lord Hill review on listings, and these are very welcome initiatives to ensure that the UK remains competitive. There'll also be a review into the UK fund sector, which will no doubt be of interest to this audience, and we hope to see mechanisms to track international regulatory developments to ensure that any decisions to move away from global standards are done consciously, and we've seen some very welcome steps by the government on green gilts and further steps on sustainable finance. An important point here is that the UK has an outsized voice compared with its population and economic share globally in financial services, and it enjoys a historical and present leadership position in a range of global regulatory forums in financial services. So we would argue that it would be in the national interest for the UK government to invest in this effort, and we hope it will continue to do so. I think one of the points I'd draw attention to as I close is that London's place as Europe's foremost financial centre developed over roughly the last 3 centuries. long before the existence of the single market, and very few people, either in the UK or in Europe, see this role changing in the near or the medium term. Which is not to say that anyone in the UK is complacent about that, but it's worth dwelling for a moment on why that's happened and where the roots in this long-standing competitive advantage come from. And some are inherent and some have developed over time, such as English and its role as the language of international business, the time zone and the natural link that gives the UK between the US and the Asian markets, the rule of law, lifestyle factors. People want to live in the UK, they like to work in the UK. We have the fantastic education and university system here, culture and the lifestyle that comes with big cities such as London or Manchester or Edinburgh. And the UK remains the world's most international full services financial centre, with the ecosystem of skills and expertise that draws in clients from around the world. And we must not look at what's just happened in terms of the UK as an international financial centre vis-a-vis its relationship solely with the EU, but also in terms of its relationship with other parts of the world. So internationally, our focus is on enhancing cooperation with established financial markets, such as the EU with Switzerland and the US, and building deeper financial links across developed and emerging economies. So some of the audience may be aware that the UK signed a trade deal with Japan on the 22nd of October last year. It's the first that differed from one of the pre-existing EU deals and saw some very optimistic, very encouraging progress in areas particularly such as data. We've got the UK-Swiss mobility agreement that was signed on the 16th of December last year, which means that for the UK, Switzerland is now our most open services market globally after Ireland. So I think it's worth thinking of Brexit as a strategic accelerator for the industry, not just here in the UK, but across the EU, and one that will lead the UK to look out further towards other markets, as well as towards our historic relationship with our European neighbours. And there is no question, unfortunately, that adding additional barriers to trade and market access is a challenge for our industry and for the customers and clients that we serve. But as we look ahead, the focus should be on working together to ensure that shared challenges are met together and to harness the mutual economic benefits of cross-border financial services. And as part of that, there is a critical need to promote global regulatory coherence on cross-cutting issues such as technological adaptation and data, as well as emphasising the need to avoid fragmentation of global markets, and in doing so, to help the fight against climate change, for instance. And these are all issues that the UK, the EU and Luxembourg will, I have no doubt, continue to work together to advance. The UK and Luxembourg and our deeply connected financial sectors will continue to share many interests. And I very much look forward to when I can travel to Luxembourg again. Thank you very much.
Well, thank you very much, Miles, for this very optimistic and yet I think also very realistic view. I absolutely share your appeal for more cooperation and for the importance of dialogue. I think we have said this time and again that yes, of course, London will remain Europe's foremost financial center, notwithstanding what some others might think. I think that London will, in the worst of cases, lose some business, the European part of it, but will still be at the top of the European financial centers industry. And we obviously have a lot to learn from you, but also as we progress within the European Union, anyway, dialogue is always important. We should definitely enhance it wherever possible. So thank you very much, Miles Celic, the CEO of TheCityUK. Thank you, and I definitely look forward to being able to come back to London as well. So happy to have you in Luxembourg, but happy to see you also in London whenever that will be possible again. Thank you very much. And now, ladies and gentlemen, we will turn to another part of the discussion for which we will receive two of the leading experts on legal issues at the Luxembourg Banking and Securities Regulator, the CSSF. And welcome back to another short segment here on Life After Brexit, where we are going to look at how the regulatory framework will evolve. And to do that, I am very happy to be joined by two legal experts from the Luxembourg supervisor, the CSSf, Banking and Securities Supervisor. Directly next to me is Isabelle Jaspart, who works as the head of division at the legal department of the CSSF, the Commission de Surveillance du Secteur Financier. And further to my left is Anne-George Kuzuhara. She is the deputy head of the CSSF's Banking Supervisory Policy and SSM Coordination Department. Both ladies have been part of the CSSF's Brexit working group and thus are ideally positioned to discuss with us where we are going from here in regulatory terms. Now, let me maybe start by Anne-George, if you want. The agreement that was arrived at on December 24th does not contain much, if anything, on financial services. Many firms now hope for the Commission to grant what is called equivalences. What should we expect to happen in the next few weeks or months on this?
Absolutely, Nicolas. It is correct to say that the Trade and Cooperation Agreement covers only briefly financial services. It sketches out some broad principles on financial services, but clearly it falls short of establishing a mutual recognition or equivalence regime. Maybe a point of attention when we talk about equivalence that I feel is important to make is that equivalents are often spoken of in generic terms. But in fact, if you look at EU laws and regulations, equivalence covers a broad range of purposes with different relevance for firms. For example, not all equivalents relate to market access. Some apply to EU firms themselves. For example, whether a EU bank can continue to treat a UK counterparty exposure prudentially the same way as it's used to before Brexit, and that kind of question. The second point of attention that I think is important to be aware of is that equivalence decision, when made, will not necessarily substitute the loss of passporting rights for UK firms for a number of reasons. First, because not all EU laws and regulations have a third country regime. And therefore equivalence is not relevant at EU level. This is typically the case for banking services and payment services. And also, when equivalence is required, it's often only one condition out of a multiple of conditions to be met by firms, such as making some diligence, applying for an authorization, etc. So you're correct in saying that in EU laws and regulations, there are a number of equivalence decisions to be made by the European Commission. The work was initiated in 2020, the equivalence assessment work by the European Commission, with the technical expertise of the ESAs, the European supervisory authorities such as ESMA and the EBA. And so far, only 2 temporary equivalence decisions have been made, mainly for systemic reasons on clearing and central securities depositories. The process will necessarily take some time because there are something like 40 plus areas to be covered. And most importantly, the Commission has made it clear that it will not only look at regulation on day one being now, but also it will look at the UK's regulatory intention in the future, meaning how the regulation in the UK might evolve, whether it will diverge or not. As we know, the UK and the EU, they have made a joint declaration on financial services in the area of mainly cooperation, where the two parties committed to establish a cooperation in financial services. And most importantly, they committed to agree on a memorandum of understanding by the end of March 2021. The idea is to, as far as we understand, to establish a framework to determine equivalence, to make equivalence decisions, suspend equivalence decision, and maybe withdraw, because obviously market participants need a little bit of predictability once an equivalence decision has been made. So we will hopefully have some more clarity once we have the memorandum in place. It's important to note that in the joint declaration, the UK and the EU said that they reserve the right unilaterally to make their own equivalence decision. And in fact, the UK has made equivalency and temporary temporary regime already applicable for EU firms. So that's basically the what is going on in terms of equivalence. All that being said, they are still in EU laws and regulation. They are places for national equivalence made by member states or national competent authorities, and the CSSF has made
yeah, that is exactly what I wanted to come to, and maybe ask Isabelle, if you want, in the absence of a decision and while we wait for a decision by the European Commission, national regulators, member states regulators are entitled to take their own decisions. What has the CSSF done in this regard? And what exactly does that mean for instance, London-based asset managers?
Okay, thank you for beginning, for having invited us today and for letting us expressing our views. As you know, Brexit was on the agenda for more than 4 years now, and during all this time the CSSF has engaged an important amount of resources to be prepared for the Brexit. We have performed a thorough assessment of all entities and all products under our supervision. And we wanted to identify whether there would be potential effects, cliff effects, arising in case of termination of the transition period without conclusion of a deal. Our work has been made more complex by the fact that until the very last minute, we did not know, it was unsure, how the financial services would be treated. We have also, in those works, assessed the needs for UK for equivalence decisions or for the conclusion of cooperation agreements. In the area of asset management in particular, but also for this applies to all investment services, the relevant sectoral European regulation, the MiFIR, Market in Financial Instruments Regulation, contains a third country regime. But in particular, it contains the possibility for the member states to set up a national regime in case there is no decision, no equivalence decision by the European Commission. That concretely means that Luxembourg had the possibility to set up a national regime for third country entities willing to provide investment services in Luxembourg. The CSSF was, of course, keen to set up such regime and organize it. We decided to do a regime which is clear, accessible, and permanent. This is particularly important in terms of stability and for ensuring the business continuity of firms. It is, this regime, especially important for asset managers, and in particular in the context of delegation of collective portfolio management, of course. In December 2020, a milestone in our Brexit works was the decision and the release of the decision by the CSSF of the equivalence of the UK for firms providing investment services to some clients in Luxembourg and the application of the third country regime then to the UK. This means that the UK asset managers may, as from the 1st of January 2021, file a form with the CSSf when they have the intention to provide services or continue providing services in Luxembourg from the UK on a cross-border basis. The form may be found as an annex to the CSSF Circular 19716. The CSSF then instructs the file, and once it has received all necessary information, it sends an authorization letter to the UK firm, and from that, the UK firm may provide investment services in Luxembourg to certain clients. We pay particular attention when instructing the files to verify that the clients that are targeted are professional clients or eligible counterparties. We also verify whether this entity is authorized and supervised in the UK. This important step is, however, not the end of the story now. The CSSF has recognized the equivalence of the UK regime, but we will continue to monitor the situation in 2021. This means that the CSSF still has to be prepared for different scenarios, being a deal for financial services or an equivalence decision by the European Commission. What makes our regime even stronger is that even in case of a decision, an equivalence decision by the European Commission, our regime, our national regime, may remain in place for up to 3 years after such decisions.
Do you know any other member states that have taken similar decisions?
We have noted that some other member states have organized third country regimes, but to our knowledge, it often is a temporary regime. For example, in Italy, they have a temporary regime giving an extra delay to entities to file for an authorization. Our regime is, as I said, a permanent regime. So our main challenge for the moment is to continue watching what will happen in the future and the UK legislation, how it may evolve. But the message is that the UK asset manager may use the Luxembourg national regime, which is permanent and which may be used from now on.
And Anne-George, to return to you, can we see today whether market participants have really implemented the new Brexit reality into their operations?
I think it's fair to say that the process went smoothly, taking into consideration the contingencies and uncertainties that we had as the negotiations were progressing. We, of course, have engaged a substantial amount of resources, as Isabelle was saying, to make sure that firms do take on board the Brexit reality. So early in the process, we have communicated extensively. We're not the only one. The EBA, European Banking Authority, also ESMA, have communicated on the Brexit topic. The European Central Bank, which is competent to supervise large banking groups in the banking union, have also communicated and asked firms early in the process to design their contingency planning, and as we were approaching the transition, the end of the transition period, to make sure that those plans are fully executed. We have stressed on numerous occasions the importance of informing the clients and the investors of the consequences of the end of the transitional period. So as I said, we are fully aware that there were some uncertainties and contingencies until the very last minute, but we have tried to provide a substantial amount of guidance to firm. On the asset management side, we have published several press releases, in particular the last one, press release 2026, which breaks down all the scenario for fund managers in the UK managing fund in Luxembourg being marketed in the UK, etc., etc. and all the steps to be taken by the relevant entities in this respect to face the end of the transition period. Of course, all this has been supported by a constructing supervisory dialogue with the institutions to ensure that institutions were effectively reorganizing their operations in line with the supervisory expectations. The European Central Bank, for example, early in the process has explained what its views were on the booking models for banks with presence in the UK, on the importance of building up management capabilities and the related infrastructure in the EU, etc. And so as a result, we have seen a number of firms relocating in the EU, and in particular, or including Luxembourg. So the smooth transition has been facilitated also by the temporary permission regime that has been put in place by the UK, which has, it is true, provided a safe harbor for EU firms active in the UK. Of course, we have made sure that entities under our supervision have applied in due time for the temporary permission regime. So as I said, we think the transition went smoothly and that the level of preparedness was adequate. Of course, our work does not stop there. As Isabelle said, we will continue to monitor the situation in 2021 and beyond, and look at the individual situation of firms, but also how the regulation evolves in the UK. For example, whether the UK will, how it will amend its Foreign Investment Fund Act, that kind of topics.
Let me pick up on this point going forward and turn to you, Isabelle. How do you see the relationship between the EU and the UK evolve, and where do national competent authorities, which are the national regulators, fit into this in their relationship with the British counterparts they have?
As Anne-Georges mentioned earlier, due to the absence of the financial services in the Trade and Cooperation Agreement, the joint declaration in which the UK and the EU committed to agree by March 2021 on the Memorandum of Understanding is, again, just the beginning of the story. So the joint declaration mentions a Memorandum of Understanding. So what I can say is that a Memorandum of Understanding is not an international treaty. So it has different legal effects and status as an international treaty. What we do not know also is whether it will be published or not. It's not necessarily published, a Memorandum of Understanding, or not necessarily in full. And it will unlikely contain provisions relating to direct market access by UK or EU entities to the other market. But what it could be, and what it should be, is that it should support a more fruitful cooperation in financial services to really build a framework for cooperation between the UK and the EU. And this should add an element of clarity for the industry. This is really important. It should build on the existing extensive works of the UK and the EU in terms of fostering cooperation. So this is for the European Union. Regarding the CSSF in particular, due to the interconnected nature of our respective markets and entities, the CSSF and the British authorities have a long and fruitful experience in terms of cooperation. Mainly with the FCA, for example, for all the asset management, or with the PRA for all banking matters. We have excellent contacts at all levels of these authorities and have exchanged in the past and will continue to exchange now whenever it is necessary to exercise our respective missions. In line with such exchanges, the CSSF has signed the Memorandum of Understanding with the PRA and the FCA in April 2019. It also entered into the multilateral Memorandum of Understanding, which was drafted by ESMA. So a first conclusion of the current situation for the moment is really positive. The first important thing is that we needed cooperation, that cooperation is ensured for our third country regime to work, actually. That was one of the prerequisites of the regime. And so we can say that from now on, and already for a certain time, cooperation is ensured with the UK authorities. And it was also really important at the end of the transition period for asset managers that cooperation is ensured. This has managed to avoid disruptions at the end of the transition period. Going forward now, we are committed to maintain this excellent relationship and the dialogue between us and the UK authorities for the supervision of the entities falling under our respective supervision. We will maybe in the future need to learn under another framework, if there is a new cooperation framework. But there is no reason at all why it should not work, because we have strong grounds of cooperation with the British authorities. And all parties are willing to cooperate in a forward-looking way. The works to be released in the next few months will be decisive in terms of financial services for the UK and the EU. We may all agree that it will be more than interesting to follow what will happen in the next few months in terms of financial services negotiations process.
Thank you very much. I take away from you, as well as from the previous speakers, whether it is the Finance Minister or Miles Celic from the TheCityUK, the importance of the word cooperation also going forward. Obviously, ladies and gentlemen, financial services are such an excessively important part of our economy. How they finance companies and so on is thus in the interest of everybody that we have a sound relationship also with our British friends, given the important role that London plays also for the financing of Europe's economy. Thank you very much for helping us understand this process of equivalence and regulatory dialogue better. We look forward to then seeing what will happen over the course of the next weeks and months on this. Ladies and gentlemen, stay with us. We will now switch to another segment of this program on how the industry actually coped with this new normal. And for that, I hand over to my colleague, Robert Yarvis.
Thank you, Nicolas. And a big thank you to our previous speakers, in particular our Finance Minister, for his positivity and optimism on multilateralism. Thank you to Miles Celic for his clarifications from the UK perspective, and likewise to Isabelle and Anne-Georges from the regulator. One thing that seems quite clear to me is that financial services have been through a wild ride in the past few years, and there's still speculations, as we've just heard, on equivalence, mutual recognition, or potential national regulatory regimes. And financial services have had to deal with all of these complications. Now we are post-Brexit, so since January 1, 2021, these businesses have had to deal with the realities of life. And that's what I'm here to discuss with a great panel. It's my pleasure to be with a couple of gentlemen who each have their very own perspective on Brexit. To my left, we have a Dutch banking representative, we have a British asset management representative, and we have a Belgian lawyer. To my immediate left is Gregor Bollen, a managing director of Citi Private Bank. He's in charge of Northern Europe and responsible for Austria, Germany, Scandinavia, Benelux, and France. He's joined Citi in 2017 from JP Morgan, where he spent 10 years as an executive director and senior banker. Before that, he spent 12 years at ING and ABN AMRO, and has been moving up in life, I would say. He's spent his initial years in Amsterdam, then to New York, then London, and now in the glamorous city of Luxembourg for 1 year. Next up, we have Noel Fessey, who is the CEO of European Fund Administration, EFA. He is also the chairman of the executive committee and has been in financial services for 21 years and previously been spending 13 years in the military. He joined Schroders Investment Management in 2000. After a few years, set up the Luxembourg operations, which I believe since then has become Schroders' biggest operations outside of London. He's a member of the board of the director of the Luxembourg Fund Association and is still a member of the strategic board since 2019. Last but not least, we have Patrick Geortay, a managing director of Linklaters. He's the national managing partner, and it's the second time he has been given this mandate, which he also held between 2007 and 2010. He's a partner of the capital markets and banking group and takes overall coordination of the office's real estate practices. He's a recognized expert in the industry, and he's also a member of the High Committee of Luxembourg's Financial Centre Brexit Working Group. Before we get started, a couple of housekeeping matters. There should be a question and answers kind of chat box below your screen, so feel free to type any messages in there as the audience, and we will ask the panelists at the end of the session. And then before we get started, I'd like to make this an interactive session. So we have a Slido question that should be at the bottom of your screen that should be visible in the next few seconds. Please do answer the question, and it's doing cross-border business in financial services after Brexit has become more complicated than before, the same as before, or less complicated than before? We'll give you a couple of minutes to think about this question, and now I'll hand over to Patrick, who, if you could, please give us an overview, because we have a very international audience, what Brexit has meant from a legal perspective and what has changed in financial services.
Well, thank you, Robert, and I'm very happy to be part of this event today. So thanks very much for inviting me to this event. Well, I think that what I will tell you now is probably, I would say, a recap of what has been already developed by some speakers earlier today. But I would like perhaps to sum up, I would say, three main takeaways. The first one is that the EU passport regime, which is a regime that allows you to provide services across the European Union on the basis of your home title, is no longer available for UK firms. That's, I would say, that's the reality, so forget about passport. That's the first takeaway. The second one, and this is something that has been highlighted by, I would say, many speakers already, is that the free trade agreement is remarkably silent on financial services. So the harsh reality, we may like it or not, but is that financial services has not been the focus of the negotiation of last Christmas. And this is, of course, something that contrasts with, I would say, the emphasis that was put on other types of, I would say, economic flows, including trade in goods and just not so anecdotically, fishing rights and the like. And that's unfortunate, but that's the way it is. So that's the second takeaway. And the third one is that, well, going forward, if you're based in the UK and if you want to provide services on the continent, at least within the European Union, what can you do? Of course, you can set up shop in the European Union, and a certain number of market players have done that. And otherwise, you have, I would say, two choices. The first one is to try to come up with, I would say, using national regimes, but in that case, this is something that is complex because you have potentially 27 national regimes that may or may not be available, or you can have the possibility to use the so-called equivalence decisions, which are supposed to be taken by the European Commission, and in some cases, this is something that will give you some access to the European Union markets, but some access only.
Absolutely. And if we could now have a look at the Slido results, they exactly mirror what we are talking about. Business has become more complicated than before, and the majority, the large majority of you in the audience agree. Gregor, coming to you, do you see much of that mirrored in practice, and which consequences did Brexit have for Citi Private Bank's operations?
Yes, well, I think I do have to agree with the majority of the people in the on the Slido poll. Things definitely have become more complicated for us, and as Patrick already said, we can no longer rely on the passporting. Servicing European clients based ourselves being based in the UK. So, as a practical consequence of that all, we have had to move the team that was providing advice to our private banking clients in the area that I oversee from London to Luxembourg.
And you yourself?
I moved with the team. Yes,
yes,
exactly. Yeah. Yes. And listen, and obviously that has implications on everyone's personal life. Although we've been promised coming to Luxembourg, everything will be great here. Just funny anecdote: in the in-flight magazine of BA coming over from London to Luxembourg, it actually said that companies have two moments when it's difficult to convince people around Luxembourg. One is to actually convince people to move here, and the other point in time is when you actually try to convince people to move away from Luxembourg. So. From that perspective, for the team and I, we're looking forward to our time here in Luxembourg. I think if we look at what it means business-wise, what we see is that obviously it is harder to advise. Well, it is impossible to advise clients. In the EU with people that are outside, and obviously in the pre-Brexit world, and that was a lot easier, right? I mean, it was easier to rely on colleagues that are elsewhere because London stays a very important centre. Financially, it is still our EMEA headquarters. We have about 8,000 people citywide working in London. And even though we have moved parts of our business to Frankfurt and the private banking part of the business to Luxembourg, we rely on product specialists and the like who are still based in London.
Okay, so you've moved some to Luxembourg, some to Frankfurt, and still can rely on a little bit of expertise in
yes.
London.
And obviously with that comes an enhanced degree of complexity.
I can imagine, yes, yeah, absolutely. So what's the daily working life now at Citi Private Bank? Is it everything in Luxembourg, or do you still have some people in London for some specialities?
Yes.
Or what did you have to move? What could remain?
Yeah, so basically everything that has to do with advising clients, meaning bankers, meaning investment counselors, all other people that actually give advice to clients, they all had to move away from London, and we moved them all to Luxembourg. What we've left in London are, let's say, our product specialists who can inform our clients, but are not giving advice to clients. And listening to what Miles has said and listening to what everybody else has said about the equivalence, it's better if you're together than if you're apart. And basically the same goes for the product specialist, right? I mean, it's better to have them together to come to to form opinions that our clients will benefit from, rather than to have basically break everything apart. So let's say the product specialists, the strategists, etc. They are still based in London, but everything that is everyone that's giving advice to our clients is based within the EU.
That sounds fairly costly and very disruptive. How did your clients react? Were they aware? Were they happy about it? Were they unhappy? Did it affect them at all?
Well, I think we were lucky enough that, or wise enough, so you wish, to have our EU clients that we were servicing out of London. We had them booked in CityUK plc, which is our Dublin-based bank. and we set Luxembourg up as a branch of the Dublin Bank. So it was fairly easy, and with not a whole lot of administrative burden for our clients to move them from London to Luxembourg, which we already did ahead of Brexit in January and February of 2020.
So you ensured no disruption to the clients?
There were no disruptions to client. Listen, we made a decision to come to Luxembourg fairly early on in the process, so we had plenty of time to replicate the booking platform here in Luxembourg and to ensure that the transition was smooth. And I have to say that talking to our clients, there was very little, if any at all, resistance of moving the accounts from London to Luxembourg.
Well, congratulations on such a complicated move, but nevertheless it does sound costly and disruptive, and that's from, let's say, the private banking industry. If I could move to Noel. Do you see the same kind of complications or disruption in the asset management industry? And what have you observed that the asset management industry went through in this Brexit period?
Well, I think my first reaction is to say we talk about costly and disruptive, and I think one of the ways to look at this is to consider it to some degree a sunk cost. You know, as is popular in the UK to say, Brexit's been done. It's a reality now, and I think Nicolas said at the beginning of this event that we settled into a new reality, and in a sense we have to find our way forward in the context of that new reality. And the question then is what does that mean? What adaptation have we made already, and what adaptation is to come? And let's be clear, adaptation is a way of life in financial services, so that we're not at the sort of year zero of regulation. It's been a long-term feature of our industry. I think what's unusual for us is the scale of adaptation that has been and will be necessary, and the degree of political uncertainty in the context of that. And all financial legislation is a political act. I mean, it is often driven by legitimate motives, but it's still a political act. So how have the asset managers adapted? And I think it depends very much on the perspective of the individual asset manager or the division of the asset manager which is affected by Brexit. So some have brought funds to Luxembourg where previously they sold European business out of the UK-based funds. Some have brought management companies to Luxembourg where previously they were working, again, from a UK fund selling into Europe, so they didn't need a Luxembourg management company. Interestingly, some have created MiFID licenses, not only in Luxembourg, but in other European financial centres as well. And largely that's because if in the past they sold discretionary portfolio management services to European-based clients from a London licensed entity, they couldn't do that in the future. So the creation of those MiFID entities in Luxembourg certainly has happened, and also in places like Frankfurt and Paris, I think are significant adaptations. All of this demands a degree of substance as a necessary condition for getting the authorizations. And so that means at the very least balance sheet, but it also means people, process know-how, support. And as part of that substance condition, you have to be very careful about how much you lean on your London infrastructure, your London group, if it is a London group that we're talking about, in order to deliver a convincing story to your regulator. I think one of the adaptations that has not yet been necessary, and I hope does not become necessary, is that we don't have to think or worry too much at the moment about delegation, because it still continues. And the Luxembourg regulator, for example, permits Luxembourg investment fund managers to delegate the portfolio management for that fund back to a London-based investment manager. And I think, you know, we talk about the free trade agreement, or the cooperation agreement. It does mention financial services quite a lot, to say that it's not relevant, it doesn't apply to financial services. It's quite a lot, actually, if you do a search. But it doesn't mean that there's no context for financial services to cross the border in the future. And the MOUs that have been agreed between the FCA and the national competent authorities in Europe, I think are the relevant foundation, or one of the relevant foundations for us to conduct business at the moment. And delegation, I think, and I hope, will continue. And there is some discussion around delegation, but that's a political act. I don't think that that's born out of any underlying regulatory need at the moment. And I think finally, if we look at things such as delegation and say, well, then what has changed, needed to change, and we need no more change than this, I'd be more careful about that, because the CSSfs press release on how investment fund management would change, has taken care in its final paragraph to advise managers that if they're using seconded staff, for example, to govern or manage the marketing process for an investment fund, then they need to make sure that those seconded staff are here in the investment fund manager based in Luxembourg and don't try to travel backwards and forwards across the border under these, what you might consider to be short-term business travel reliefs. The substance is here, and so it should be.
Yeah. Like the Paul said earlier, it sounds complicated and costly, and certainly somewhere a loss of efficiencies. What about, as you're the CEO of European Fund Administration, has Brexit affected your operations, as in the entity itself? As you have more business, less business?
I think that's a perspective question again. So because my business is principally focused on continental European asset managers and principally Luxembourg domiciled funds, albeit not exclusively, we do have some asset managers based in the UK, and we have funds, we service funds which are not based in Luxembourg. For us, Brexit is not a major event. It has not been particularly disruptive nor expensive, but as a British national, it has been very interesting.
Interesting is the right word. I'm
Indeed.
also a British national, and
yes.
It did hurt for a long period. I would like to now come quickly to the second question to the audience. We could bring that up. It's a more technical one and probably a more difficult one to answer for the audience, but please take a guess. And remember, it's about equivalences. I mean, what you need to understand is that right now there's 2 equivalences granted between the UK and the European Union. That is for derivative clearing houses and for Irish securities transactions. So the question is, how many equivalences will the Commission grant the UK in the future? Either 0 to 4, that's more or less where we are now, 5 to 10, or more than 10, or if you're not sure. Take into consideration that the US and Switzerland both have around 20 equivalences granted. Now, whilst you mull over that question, I wanted to give Patrick the floor to potentially explain to us in practice what can equivalences mean for financial services and how many are there, and from your point of view, can we expect any?
Look, I mean, equivalences will help, of course. They will help, but I would not dare to say that they will really, I would say, be the panacea. They will not be the solution. And there are several reasons to that. The first one is that, the equivalence regime, and I should say regimes with an S at the end, they are really patchy. We're talking about 40 different regimes, and they apply to, some small bits of the operation of a player. They apply to certain market players. They apply to some services. So that means that it is something that is certainly not as I would say as consistent as the passport used to be. They are also limited. So what we're talking about equivalences, we have to bear in mind that there are many core areas for which there is no equivalence regime. That's as simple as that. So for instance, in banking, the banking products, deposit taking, no equivalence regime. Lending, no equivalence regime. This is really the core of banking activity, and you don't have any equivalence regime on which you could possibly rely. Equivalences, in addition to that, are, I would say, potentially hard to obtain. This is, of course, a technical process, but this is a process that takes time. And it is also a process that may be politically influenced. And of course, this is very much a one-sided process. So, that's the nature of, I would say, the process. The EU will have a look at the UK standards and will have to decide whether the UK standards are consistent with the European standards. Equivalents, in addition to that, are uncertain. They can be, I would say, quickly withdrawn. The reality is that they can be withdrawn at very short notice, as little as 1 month. And, some of those equivalences are granted for a limited period of time. And this is what we've seen for the first 2 equivalences granted to the UK. So the first one on derivatives clearing, we have a temporary regime until June 2022, 18 months. And for the second ones, for the settlement of Irish securities, Irish transactions, we have just 6 months, which has been granted by the Commission. So it's really a temporary fix rather than something that is supposed to be permanent. So yes, I mean, equivalences will not necessarily be the solution. I expect, I would say, some more equivalences to be granted to the UK for the reasons that that have been mentioned, because the reality is that the current regime in the UK is broadly similar to the European regime. But we should not expect, I would say, huge acceleration in the coming months. I hope that the Memorandum of Understanding will help. And I think this is an instrument that will be designed to really, I would say, create and build trust between, I would say, the two parties. But I don't think that there will be a very big push in the coming months, not least because there is, I would say, a perception, at least on this side of the channel, that the UK might be tempted to diverge from the EU standards, and of course, it is something that will not help.
Could we have a look at what the audience thinks on the amount of equivalence that may be granted? Okay. So the audience disagrees with you, but I'm not sure that the audience knows as much as you do on the equivalence process.
It's a question of timing. It's a question of timing.
I think it's time. I'm with the audience on this one.
A question of time?
Yeah,
in which sense?
Will, but that comes back to that macro point.
But isn't the more time we spend without equivalence, isn't it more likely that there won't ever be any granted?
No, I'm not so pessimistic. I mean, I agree with Patrick in a sense about the utility of equivalence. In a sense, in bankers speak, it's kind of like liquidity mismatch, right at the core of your regulatory existence. And that's that ability to withdraw equivalent decisions, which are unilateral, understandably, in a sense of sovereign power, in this, is a concern for any business which tries to build on that. But if you look at the EU Charter of Equivalent Decisions that they've made, then there are many of them, and they apply to many, many countries. And if there weren't several, and I would say more than 10, equivalence decisions granted to the UK in the long term, or the medium term, the long term's too far to think about, then I think that would be really unusual and so different from the treatment of the rest of the world that it would point to a much deeper political problem. And I think this is a political issue. Yeah. So I think it will come. And so many of them exist that they must have some utility, so that it's not that they're completely useless. But I do think, and maybe that's the banking question, would you bank your business on an agreement that could be pulled?
That was my next question.
Sorry.
No, please.
I have previous at moderation.
No, that was my next question. To you, Gregor, in practice and operationally, would an equivalence in private banking areas, would that change anything to your business model between the UK and EU?
I don't think so right now. I mean, obviously we have to, and that's like Patrick said, the equivalences can be very quickly withdrawn, and they can be very, can be very disruptive if they get withdrawn or granted, for that matter. And so I think what we need to do is we need to, and our role as private bankers is to service our clients as best as possible, and to minimize disruptions. So I think in terms of how we service our clients, we will base ourselves on as much certainty as we can, and obviously, given that private banking deals with individuals, EU citizens, wealth, we can't take any risks there. So we will not bank on equivalence, and we'll just base ourselves on the set of rules that we know that we have to live by.
Yeah. Okay, that makes a lot of sense. Another point, perhaps, Noel, that's been in the news over the past few weeks is the level of share trading that has moved from London to other European cities, notably Amsterdam in particular. Does the location of where shares get traded, has that had an effect in the asset management industry? And is that a long-term significant impact to anyone?
So I fundamentally, with respect to Amsterdam particularly, and not making a comment on London versus Amsterdam as venues, I don't think it has a significant effect in that specific case. I mean, it's certainly an interesting migration. And I think if you were to put your mind back in 2016, would we have anticipated this? Then I think not. But asset managers trade on markets all around the world, and I don't think they have great difficulty accommodating this shift to Amsterdam. Maybe there's some element of timing, which was, in a sense, a surprise. I think we've also got to be careful that some of these surprises are somewhat confections in the press, is that it makes good press to be dramatic about some of the changes which are happening because of Brexit, when actually I think it's in everybody's interest to keep calm and assess what changes are absolutely necessary and make them with minimal possible disruption. So I think share trading itself, listed shares, no great concern. I think I'd be more cautious about what's the possible future for derivatives and the regulatory regime around derivatives. And I don't really know where that's going. And I think there's a lot of debate, and that's the uncertainty, and that's the political component. And that comes back to something that Miles said in his. He talked about the UK's ambition, again, a political ambition to diverge, one which I think is shared by many City people. So they do have this global perspective. I think they have fretted somewhat at what they see as European regulatory encroachment upon ancient freedoms of the City of London in its global context. So if divergence is what you want, but then you say that regulatory arbitrage is not what you want, how do you reconcile those two? How do you give clarity on direction? All of these were Miles's points. And how do you do so in a way which generates trust? And I think that's the big uncertainty about what the evolution for our industry will be, because asset management is more than just a fund business. It's everything to do with managing the portfolio and trading those securities or those financial instruments.
Perhaps, Patrick, I know that we spoke about this, that finance is probably the most globalized industry. And do you see Brexit becoming a kind of an impediment to this, or a start of something new, a more regional version of finance? Or what's your perspective on this?
Okay, well, look, I mean, at the risk of playing the political commentator, which of course I'm not, I have the impression that Brexit was fueled by really a certain dislike and a mistrust of globalization. So Brexit has never been a good news, for, I would say, global industries. And you can argue that the financial services industry is one of the most integrated, the most interconnected industries in the world because of the nature of the business. Now, what is interesting to note, and this is something that is not, I would say, necessarily, I would say, focused on financial services, but what we've seen in the European Union is a few important progresses made, last summer, for instance, in the midst of the pandemic. A certain number of important decisions have been taken. And in addition, what has also been remarkable is to see the unity displayed by the European Union during the negotiation process. And there is therefore, in my view, a possibility for a deeper integration, but at a regional level. So there may be, I would say, a stronger regionalization going forward, for instance, at the level of the European Union. And that may be, perhaps, I would say, a solution, or I would say sending the right signal to the wider public in reality, in terms of, I would say, the benefits of remaining interconnected and integrated going forward.
Yeah, that again, there'd be a balance to strike in terms of what is possible and what is not possible should Europe diverge greatly from what the UK is right now. No, in terms of the demanding areas in the asset management space, what are the key struggles now with Brexit that your clients are potentially dealing with?
Well, apart from uncertainty and the points that we've made already in this conversation, I think Brexit is in some senses, Brexit, the living of Brexit, is because it's a fait accompli, but is it really? I think it's an exploratory process, a little bit like it has been in terms of the trading goods and other services. So British exporters are finding that, yes, of course, there are no tariffs, but there are other non-tariff barriers to trade. And it depends, again, on your perspective and to some degree your political affiliation, whether you think those are significant or not. So as we go forward, I think, in financial services, particularly once international travel restarts, because at the moment we're all working digitally, and humans are not really crossing borders, then I think we'll start to explore the meaning of what services can cross a border, particularly in an intra-group context within financial groups. So to what degree can your UK-based business provide services of sorts to your Luxembourg-based business in the way that it provides services to your Hong Kong-based business. How is the Brexit agreement affecting that? And so we heard the example of client advisors, for example, being brought over the border. Definitively here, this is where the substance is, this is where the balance sheet is. But product managers being able to cross the border on short-term business trip terms. And there are many examples above and beyond product managers, and if I think about asset management product managers, they would have the similar sort of travel requirement. Would your portfolio manager be able to travel from London to meet an institutional client in the UK when the regulated investment manager, portfolio manager for that mandate is actually based in the UK? What's the status of that? And the free trade agreement that does exist does permit these short-term business trips, even if financial services are excluded. We have some exploration to do there.
That's still unclear.
I think we'll find it out at the borders when that nice chap at immigration says, "What's your business here? Why are you coming?"
Let's hope it runs smoothly.
And just to be clear, if you think I'm over-egging, if you think I'm emphasising this too much, just think about some of the conversations that we've had over the past 5 or 6 years about people doing business cross-border and the potential tax effects in terms of permanent establishment. And people being really surprised at the lengths that tax authorities would go to investigate what were you doing in our country on these days. So I think there's much opportunity for exploration. I wouldn't say mischief, but I would say exploration.
No, but there are a lot of small operational issues that may arise. I'm looking at my colleague Chris. I assume we have some questions coming up. Just before we go to the Q&A session, this is all very pessimistic, and it's easy to be pessimistic about Brexit. But Gregor, is there perhaps any silver lining that Brexit has had to Citi's private banking operations? Is there anything positive or good out of all of this?
Absolutely, absolutely. No, listen, when people ask me, why did you guys move from London to Luxembourg, everybody expects you to say, well, it's been Brexit, it's been MiFID II. I mean, obviously, those have been. So you will tailwinds in our decision to come here. But I think the biggest reason for us to actually pick Luxembourg over any other country in the EU is the ability that we currently have to benefit from the lively financial ecosystem in Luxembourg and the structuring possibilities that it gives for our clients and the clients and wealth that is structured through Luxembourg for us to tap into that.
Mm-hmm. And in terms of operations, is it perhaps better managed not to have all your eggs in one basket in London? Is there any kind of positives that you've boosted your Frankfurt office as well, that it's perhaps more sustainable, if you will?
No, I think if I look at our pre-Brexit situation, we already had booking centres in London, in Jersey, and in Switzerland. So that already is diversified. From a client perspective, everybody in the EU, according to MiFID II, has to have their accounts within the EU. So there is for all regulated activity. So there is already very little. There are very little options of doing diversification on a legislative framework.
Okay, thank you. Chris, is there any questions from the audience?
Okay, thank you very much, Gregor, Noel and Patrick, for that very interesting panel, and thank you, Robert, for moderating. There's been a couple of questions coming in. I think the first one to kick off is from Alex Lehman and Bruegel, which is a sustainable finance-related question, on sort of new regulation incoming. So it's, does sustainable finance, which will have a global relevance in the race to net zero, warrant harmonisation or regulatory competition between the UK and the EU? So more broadly, to extrapolate for the new regulation, not for the existing stuff, do you see that as a potential ground for competition or harmonisation in the EU? Maybe Patrick would like to go first from a legal perspective.
What I would say is difficult to of course to be definitive on what the future will bring, but it is clear that if there is really I would say an actual competition starting to develop between the UK and the EU, it will probably not facilitate, equivalence decisions and these type of things. So that will add a little bit in the, I would say, the political dimension of the process. But I would think that, with a certain number of mechanisms being put in place after, this memorandum of understanding will have been, I would say, approved by both sides, at least there's going to be, I would say, a forum in which, this potential for divergence will can be discussed between parties, and perhaps at the end of the day, the EU may also decide that there are some, I would say, moves that should be made towards, I would say, other solutions. But of course, it is speculation at this stage. My kind of initial reaction would be to say, look, I mean, if there is a potential for divergence, it may complicate a little bit the process, but it depends on I would say, the rationale behind this divergence, I suppose.
No, you're shaking your head agreeingly.
I'm generally agreeing. I think. Look, I mean, the EU taxonomy, as an example, is a good start for how you should develop thinking around what is sustainable, and I'm sure that will develop in European regulation into some form of clarity, conformity, regulatory basis upon which we can ensure that customers get access to genuinely ESG-type products without greenwashing. I think there's a coherence point here, and there's an efficiency point for asset managers who work in more than just the European or the EU regime, so the global asset managers, even if EU-based, who in a sense have they may be happy to follow with the EU regulations for as long as those regulations are attractive. As soon as those regulations become more imposing and in potentially a legitimate view onerous, then you may find that asset managers working in other regimes prefer to adopt those other regimes' emerging sustainable regulations. And I think the UK might well be an example of that. It's not that the EU, for example, has a monopoly on sustainability or sustainability thinking. The issue for producers is one of duality, is that you will end up trying to produce products for more than one regime, and perhaps that's inevitable. But that involves cost, duplication, etc. So it's back to your point. Theme. But it is a sunk cost. Yes, it did happen. Absolutely. So, and I think to your optimism point, I'm not pessimistic. I would have preferred it not to happen, but it has happened. So, and to the finance minister's point, let's deal with it in a cooperative way.
Absolutely. Any other questions?
So one anonymous question, which was obviously the panel is focused primarily on the UK-EU relationship in life after Brexit. But what about the international picture? Is there a potential impact in terms of the London, losing flows out to other places in terms of New York or Hong Kong or other places around the world? Maybe one of our practitioners, Grogor or Noel, would like to jump in on that one.
Gregor, I've heard this discussion many times as well, that to avoid the complications of the Brexit situation, people will just execute trades or deal with New York because they know what those relationships are like, or Singapore. Has anything like that happened to you, where it's almost kind of bypassing the UK?
No, I haven't seen any of that. And in terms of trading, the trading activities that our EU-based clients do with us previously went to London, but in terms of the repeating theme of duplication, we've set up a trading desk for our clients based in Luxembourg. So we're basically able to provide the same quality of service and the same coverage that we were previously providing from London. We currently provide that from Luxembourg. Again, because of the regulatory framework that we're bound to, it has to be here in the EU, and we cannot have EU clients trade, for example, with New York and with.
But for things like portfolio management and asset management, I think that is the reality, perhaps, that some portfolio management could be delegated to New York instead of London in the future.
Sure it would move any more than it would have done in the past. So New York would have had North American asset managers. Hong Kong would have had Hong Kong Chinese, etc. Yes. And I think we've all seen in the newspapers people speculating that the London's competition is indeed New York, not Europe in a sense. But that's more a banking comment than and I would say Gregor's given a great answer to that. I would come back finally just to the sort of, I think if there is a competition, I think it is continuing between the UK and EU domiciles for funds, for example. UK investors who had developed quite an appetite for Irish and Luxembourg funds are more likely to shop at home in the future for a variety of reasons. And I think the UK domestic fund industry will profit from that. On the institutional industry, for matters such as private assets, I think the UK is potentially in quite a competitive position. And so for global capital. So I don't see any reason why London should be afraid of developing a very successful industry.
Thank you. Unfortunately, we have to wrap up now. I would love to continue this discussion and also talk about the legal sector's implication of Brexit, but we have unfortunately run out of time. So I will hand over to Nicolas briefly, but I'd like to thank Gregor, Noel and Patrick, and also our sponsors, and of course to you, to the audience, for taking a part in this session. Now I'll hand over to Nicolas, who will have an interview with Steve Jacoby, the managing partner of Clifford Chance, on the implications of using Luxembourg law in cross-border financial services. Thank you very much.
Thank you very much to our panelists for this very interesting discussion. And before we conclude, let me turn to another angle of Brexit that may not be so well known. Attention has been focused very much in the media, in the industry, and obviously also in the political sphere on relocation of activities to different financial centers. But there is also one story, and that is what we will be discussing in the next couple of minutes, and that is on the use of, in this case, Luxembourg law for international finance transactions. We have indeed seen that since Brexit has become a reality for the financial industry, it has also turned and changed the way, for instance, Luxembourg law is used in major transactions. To discuss this, I have with me today Steve Jacoby, the managing partner of Clifford Chance Luxembourg. Welcome, Steve.
Thank you very much, Nicolas. It's a pleasure to be here.
Thank you. What applications do you see of Luxembourg law in international finance transactions?
So I think it's important to say that what we're speaking about here is cross-border finance transactions. So really international finance transactions. Parties actually have to choose a governing law for their contracts. So I don't want to be too much of a lawyer when explaining this, but it is quite important to go through this. So in a domestic transactions, parties will naturally choose normally the law of the local jurisdiction. But in the international transaction, they can choose a governing law within certain limits. Now, Luxembourg law has been for a long time a recognized choice in this area, actually. So a number of applications, obviously company law structures, investment fund structures have naturally been governed by Luxembourg law if they were based in Luxembourg. We have seen that transactions on Luxembourg assets, particularly collateral transactions, were very often governed, and most of the time governed by Luxembourg law, because it's the law of the location of the assets that determines most of the time the correct governing law. And we have seen there that the 2005 law, which is the law on financial collateral arrangements in Luxembourg, has shown that this is a regime that is a recognized strength of the Luxembourg financial center. It's been in application for more than 15 years, and it is recognized as a regime providing legal certainty, robustness, at the same time agility to adapt to the needs of the transactions. But there have been cases also where Luxembourg law was chosen for the whole transactions. So to govern all of the contractual elements, the lending elements, the law governing the debt securities or other securities issued, etc.
Has this changed since Brexit?
Well, I think the evolution we have seen since Brexit is that while English law has been a standard choice for cross-border finance transactions in Europe and in other, even globally, parties have been looking at this again in the light of Brexit. I mean, English law will remain an important law, a law that people will choose by way of tradition and because it is recognized as an efficient and robust law, but there are situations where they are looking at the laws of other EU member states to govern their transactions. The reasons may differ, but I think what is already important to note that is when parties move to a certain law as their governing law, especially where they have a choice, they will be driven by, on the one hand, adaptability to their transaction and robustness and legal certainty.
So what are the major drivers for market operators to choose Luxembourg law as the law governing their transaction?
Well, there are a number, and I can't go through all of them, but I personally see three main drivers. The first one, as I just said, is the combination of legal certainty and adaptability that the Luxembourg legal regime offers. Luxembourg is a law that is generally seen to be providing this legal certainty and robustness to sophisticated market operators. And the most important thing is that they are able to determine in their contracts what their transaction is and that they have comfort and in the robustness that these contracts will indeed work and be adhered to. And Luxembourg is a law that has a joint heritage with other laws that of the EU member states that come from Napoleonic codes, so French law, Belgian law, and it also has remained close to major principles which market operators understand well. The second driver I would see is innovation. And we have seen in recent times that the EU has brought in legislation, directives or regulations to harmonize certain areas in which cross-border EU transactions need to take place to support the same reasons of robustness and legal certainty. And this, together with the implementation of that under Luxembourg law, together with domestic initiatives, has created a legal fabric which really provides tailor-made solutions and which parties can rely on. I'll give you two examples. A recent example is the law of July 2020 on professional payment guarantees under Luxembourg law. Now, again, this is not the place to go into the details, but just to say that this is a form of personal guarantee that has now a statutory recognition, which can be used for a wide variety of transactions, where previously there were some legal impediments, there were some issues of characterization, etc., but now it can be used from the usual use of guarantees, which is credit support in financial transaction, over to much more sophisticated structures like securitization or credit risk transfer transactions. The third element, or the third driver, is around debt capital markets. So that flows naturally from the argument I just made. And Luxembourg has been, as we all know, recognized for a long time as a global center for capital market transactions, as a listing venue with the Luxembourg Stock Exchange, but also as a center for custody of securities, investment funds, and other infrastructures. What we have seen in more recent years is that there is an increased use of Luxembourg law as a governing law for debt capital market transactions, so the issuance of bonds, of notes, and other structured instruments. We've seen private operators use it, but we've also seen European and international financial institutions, some of them headquartered in Luxembourg, use it as well. So as an example, the European Stability Mechanism, the ESM, has announced that it will be issuing securities and has been issuing securities under Luxembourg law. This is, I think, is an interesting element for development because as we see projects like the CMU, the Capital Markets Union project of the Commission, progress, where the Commission seeks to, and the European institutions seek to deepen and widen the capital market access of market operators in the Union, Luxembourg law can really play an important role in that as a governing law.
Now, from your vantage point, what other trends do you see, and what will be the impact of this on the use of Luxembourg as governing law?
Now, there's the kind of question where one needs the proverbial crystal ball to be able to answer it. So I'll give a few ideas, others may have others. But I think the first thing to note is that to a large extent, the choice of Luxembourg law, or the choice of a governing law, is determined by legal considerations, but also by other considerations like tradition, reliability, efficiency, and market acceptability, where Luxembourg law has an interesting card to play for all the reasons we said. Parties will also naturally look at the law of their jurisdiction, where they're based and from where they're doing the transaction. So be that issuers, investment funds, investment structures, or lenders, if more of them are based in Luxembourg and doing the transactions out of Luxembourg, as is one of the consequences of the relocations, we will see an even greater interest in using Luxembourg and Luxembourg law. Another factor is the future structure and the way that EU financial markets will work in the future. So there is the relationship with London, obviously. What is the role that London will continue to play, which we've heard a lot about today. But there is also the role that the EU can play as a power, a financial power in the region, and how much projection it can do into the wider region beyond maybe just Europe and globally, which will also be an element that will support the use of EU member states law and Luxembourg law in particular. And finally, what one sometimes hears is that in relation to all of these initiatives that I mentioned, Capital Market Union and some of the other harmonization projects of the European Union, is there still a place for national law? Well, I would think certainly yes, because when one looks at these projects, they're all about creating the infrastructure, the architecture of the market, and making sure that it is robust, that is adapted to the needs of the operators, and that creates legal certainty in order to foster these financial transactions which are important for the economy. And there is still a significant role in there for national laws, be it civil law, commercial law, contract law, securities law, because not everything is harmonized. And with Luxembourg law being an innovating law, but one that is also focused on robustness and adaptability, agility to the needs of the operators. And if it remains that, it can certainly be a very interesting choice for many of these transactions.
Thank you very much, Steve, for sharing your insights with us and with our audience. Thanks also to all the other speakers who have helped us here clarify a little bit what life after Brexit may look like. Thanks finally also to our sponsors who help us make this episode possible. I would like to invite you all to join us again on March 23rd for a next episode of Focus On, this time focus on the Capital Markets Union. Until then, stay safe. Thank you very much.